Bessent will sell US debt for stables, he'll cut US debt in half and inject trillions in crypto. I got leaked White House reports and was shocked. Here's his secret plan and how it changes #crypto. Before we dive in, smash that follow, like, and retweet button. I've put a lot of effort into this thread, and your support would mean a lot. Let's spread the value. 1. Scott Bessent isn't a household name for traders, but in US finance he's a heavyweight. Soros Fund CIO, founder of Keyscore Group, and now part of Trump's economic advisory team. His latest play, use stablecoins, crypto's fastest growing sector, to finance US debt. 2. The US funds itself by issuing treasuries instead of raising taxes on the spot. Foreign governments, banks, and institutions buy those bonds, keeping the dollar as the global reserve. But demand is fading. China and Japan are scaling back, and the $37 trillion US debt keeps climbing. A shrinking bear base creates a dangerous gap in America's funding model. 3. China and Japan, once America's biggest creditors, have been cutting back their treasury exposure for years. Meanwhile, US debt has ripped past $37 trillion, with Congress forced into constant ceiling hikes just to avoid default. The 2023 standoff showed how fragile the system when new financing stalls. That's why Bessent is pushing stablecoins, a new pipeline of demand that doesn't rely on foreign central banks. 4. Stablecoins are dollar-pegged tokens that run on crypto rails but rely on traditional assets for backing. Right now, 90% plus of supply is backed by cash or short-term treasuries. New regulations like the Stable Act and Genius Act would lock this in, forcing issuers to hold 1-to-1 reserves in US debt or cash. In Bessent's model, every fresh stablecoin minted equals a new beer of treasuries, turning global crypto adoption into a funding engine for Washington. 5. This strategy bypasses state-level de-dollarization. Governments like those in BRICS Plus can cut treasury exposure, but citizens in Argentina, Nigeria, Turkey, and beyond still demand dollars. For them, USD, physical or digital, is the safe asset compared to collapsing local currencies. Stablecoins let the US project dollar dominance directly to people, skipping unfriendly central banks and regimes. 6. In places like Argentina, Nigeria, and Turkey, parallel markets for dollars are already entrenched. Locals turn to USD as protection when inflation wipes out their savings. Stablecoins supercharge this instant access, borderless transfers, and resistance to capital controls. For the US, that means ordinary citizens abroad become constant indirect buyers of treasuries. 7. At scale, this flips the structure of US debt financing. No longer concentrated in Beijing or Tokyo, but spread across millions of wallets worldwide. Each minted stablecoin equals new demand for treasuries equals steady bid for the dollar. A mix of macro engineering and geopolitics disguised as crypto innovation. 8. For crypto, it cuts both ways. Stablecoin rails bring millions into the ecosystem, even if they only hold digital dollars at first. But power concentrates in a few compliant issuers, squeezing out decentralization. The upside once inside, it's just one step from stables to BTC, ETH, and beyond. 9. Bessent's plan isn't a magic fix. $370 debt won't disappear just by shifting who holds the bonds. Stablecoins might prolong the dollar's dominance, but they don't solve overspending or long-term inflation. Eventually, faith in fiat could falter, and hard assets will reclaim the safe haven spotlight. 10. If Bessent's strategy succeeds, stablecoin market cap could soar, bringing billions in new treasury demand. That would help stabilize US borrowing costs, slow de-dollarization, and give Washington breathing room on fiscal policy. But history proves all fiat eventually fades when that happens. Bitcoin's fixed supply and scarcity could make it the ultimate winner.